All right, let's jump right in. If you're thinking about buying your first rental property here in Canada, you've got to understand this. Your income structure is a huge piece of the puzzle for getting a mortgage. I mean, it's not just about the number on your pay stub. Lenders dig way deeper. They want to know where that money comes from, how long you've been making it, and most importantly, how stable it is. So in this explainer, we're going to break down how lenders see your income, what paperwork you'll need to have ready, and how that all translates into how much you can actually borrow. So, here's the game plan. We're going to start with how lenders look at your income. Then we'll cover exactly what you need to prove what you earn. And finally, we'll get into the nitty-gritty of calculating your borrowing power. Simple as that. All right, first up, how lenders see income. It's not just about how much you make, but where it's coming from. This is super important because, from a lender's point of view, not all income is created equal. What they're really hunting for is stability. They want to know without a doubt that you can make those payments month after month, year after year. So lenders pretty much bucket your income into one of four categories: full-time, part-time, contract, or self-employed. Now, every lender has their own little quirks, but there's a big one you'll see almost everywhere. They want to see a 2-year history for most of these. It's their way of making sure it's consistent. The one place you might get passed on that, a guaranteed full-time salary. Okay, let's move on to proving what you earn. This is where you back it all up with paperwork. Once the lender knows how you earn, you've got to prove what you earn. And seriously, a little pro tip from me to you, get all your documents ready to go before you even start applying. Trust me, it'll make your life so much easier. So if you get paid by the hour, lenders are going to want to look back at the last 2 years to figure out a nice, stable average income for you. To do that, you'll need a few key things. Your T4 slips for the last 2 years, that summary of earnings from your job, plus a letter of employment, and of course, your most recent pay stub. Now, if you're on a salary, good news. This is usually the simplest type of income to prove. Most of the time, all you need is that letter of employment and a recent pay stub. But, and this is a big but for a lot of you investors out there, if you're counting on things like overtime, bonuses, or commissions to qualify, well, then you're right back to needing those last 2 years of T4s and your notices of assessment from the CRA. All right, let's talk to my self-employed folks, whether you're a sole prop or you're incorporated. Don't worry, it's totally possible to get a mortgage. In fact, lots of lenders have special programs just for you. The main thing is you'll need your last 2 years of T1 generals. That's your personal tax return and the matching notices of assessment. And if you're incorporated, you'll also have to hand over your articles of incorporation and your corporate financials, also known as your T2s. And hey, don't forget about other ways you might be earning money. Lenders can sometimes look at other income streams to help you qualify. We're talking about things like commission, bonus income, spousal or child support, disability or pension payments, even child tax benefits, a vehicle allowance, and of course the big one for us, rental income. Super helpful. Okay, time for the final piece of the puzzle, calculating your borrowing power. We've talked about what income counts and how to prove it. Now let's see how lenders take all that information and turn it into an actual mortgage amount. This is where the rubber meets the road. So the magic tool lenders use to figure out how much you can borrow is called a debt servicing ratio. The best way to think about it is like a financial stress test. It's a simple calculation that measures your ability to handle all your debts compared to your total income before taxes. And there are 2 of these ratios you really need to know. The first is GDS, or gross debt service. This one just looks at your housing costs. We're talking mortgage, property tax, heats, and if you have a condo, 50% of the fees. The second one is TDS, or total debt service. This one takes all those housing costs from GDS and then piles on all your other debt. Yep, car loans, student loans, credit card payments, the whole shebang. So, how does this all fit together? Well, take a look at this diagram. It's pretty simple, right? You've got one circle for your income, everything we've talked about proving. You've got another circle for your debts. And that third circle, that's the lender's rules, those GDS and TDS ratios. Where do you find your mortgage capacity? Right there in the sweet spot where all 3 circles overlap. It's that perfect balance between what you make, what you owe, and what the lender feels is safe. It's all designed to make sure you're not stretched too thin. Hey, if you got something out of this, do me a favor and hit that subscribe button. I'm putting out new stuff for investors every single week to give you a solid foundation. But, if you want to go even deeper, I also do live training sessions. We get into everything: financing prep, credit, income, down payments, the whole buying journey. Just check out my channel page for the next available dates. And that's a wrap.
Look, getting a handle on all these pieces is absolutely the key to financing your investments the smart way. So I'll leave you with one final thought to chew on. Now that you've seen how lenders are going to look at your income, is your financial story ready to be told?